Okay, hello there. If we could go to slide 2, please. And just a quick refresher on where we've been and where we're going today. Last week, we talked about thinking about whether you should buy or not buy a house. And we talked about the benefits and the disadvantages to that kind of purchase, some of the costs, and the way to think about where you might start. Today, we're going to get into a lot of detail about financing that home purchase. Talk a little bit about just understanding what a basic mortgage is, but then get into a lot more detail. We're going to be touching on 6 to 8 different types of programs that help buyers finance a home. So there's going to be a lot more technical information today, but as Raul said, you can get the PowerPoint afterwards, and that will probably help you as you go back over those parts of the slides that are the most of most interest to you. And of course, the websites are also put on the PowerPoint, the link, so that you'll know how to find these parts that you're most interested in on the internet. Given that a lot of this information is more technical, we think that it might make sense if you have a question as we're going along, feel free to just ask it rather than having to wait until the end, because that might be more difficult than for you to remember and even for us to know exactly which program you're referring to. So with that, let's get going. Slide 3, please. So what is a mortgage or home loan? Well, the word mortgage is often used when we're talking about a loan to buy a home. And so sometimes you'll just hear the word mortgage, and that means a home loan. It's an agreement with your lender. It's a legal agreement. And what you are agreeing to do is to repay the money that you've borrowed plus interest. There's a time period that is set for these payments. Now, we talked about this a little bit last week. Normally, it's a 30-year time payment or time horizon, if you will, 30 years to pay off that borrowed money. Sometimes it's 15. So it's a long payment time period. And normally you will pay this payment monthly. Now, keep in mind that you don't completely own the home until you pay in full. And that's why this is an important legal agreement with your lender. In effect, it's a little bit like you're sharing ownership with the bank. And that's important when we get to understanding what a foreclosure is. So with that, let's move to the next slide, please. So we touched on this last week, but let's go over it again in a little more detail. The monthly payment. What is in that monthly payment? The most obvious two pieces are principal, and principal is the money, the amount of the borrowed money. Principal is the amount that you've borrowed. In other words, you want to buy a house, you borrow $100,000. 100,000 is the principal amount. And that's the borrowed money. Interest is the amount that the lender is charging you to use its money. Both of these pieces are part of that monthly payment. So if you think about a 30-year loan and you've borrowed that $100,000, that $100,000 is going to be chopped up into a bunch of little pieces so that over the course of 30 years, month by month by month, all of that $100,000 will be repaid, plus all of the interest over that period for using that $100,000. So that's how the lender is stretching out the payments and how how the borrower pays back the whole loan plus the interest. Normally, you're also going to have to pay these other amounts of money for mortgage insurance, which we talked about last week. And mortgage insurance, if you remember, is that insurance that the lender wants you to pay to protect the loan that the lender has made to you. And this is normally for any loan where your down payment is less than 20% of the value of the house. But beyond that, there is homeowners insurance, always something that's important to protect your interest in the home, and property taxes, another cost that you can't escape. And normally in the all of the programs that we're going to be talking about, these additional payments are rolled into what's called the monthly payment. Okay, so with that, turn it over to Anne.
Okay, so what is your loan based on? So we did talk a little bit about this last week. So your loan is usually based on all your finances. So that includes your income. Lenders will like to see some kind of regular income with good documentation that goes with it. They'll also look at your savings and any available cash that you have. They'll definitely, most of the time, consider your credit history, and they'll want a good credit score. As we'll see, some mortgage programs do not require a good credit score, but most really do. And again, good credit score is in the 600s. And they'll also look at your current debt, which means the current amount of money that you owe whoever you owe it to. So that could be a student loan. It could be a car loan. It could be credit card amounts that you still owe. All right. So generally a lender is going to look at all those things. And one thing that you can do that's good preparation for applying for this mortgage is to make sure that all these things are in good order. So if you have some high credit card debt, for instance, try and pay it down. If your credit score is not very good, try and get it to be better. So the mortgage structure, or what sort of makes up that mortgage. So usually you're going to be looking at a few different things. As Bob already mentioned, the number of years that you have to pay it, typically 15 or 30. It's not usually some random amount in between. It's usually 15 or 30. The interest can be at a fixed rate or a variable rate. The fixed rate is really nice because then it's predictable. It's going to stay the same through the entire period of the loan. If it's variable, it usually goes up and down with things like the bank interest rate. So that makes it a bit less predictable. So in general, a fixed rate is kind of nice because you know what you're getting yourself into. The interest rate might be higher or might be lower. That really depends on the things we just mentioned, your finances. There's always going to be a down payment. In some mortgages or loans, this down payment can actually be zero. And you can get additional assistance with your down payment. But this is something to pay very close attention to, because it can vary usually from something very small like 3% up to something really big. So you have to be careful of that. Closing costs, we talked a lot about this last week. This can be quite a lot, or it can be, not very much. Some mortgage programs, they pay the closing costs, or the lender pays the closing costs. But much of the time, you do have at least some closing costs to pay. And also with some of the mortgages we're going to talk about, there can be restrictions on either what you can buy or where you can buy it. Okay, so again, very important thing to take into account when you're looking at different mortgages. So today we're going to concentrate on several different kinds of mortgages. First, we'll talk about the traditional mortgage with a bank or other institution. This is the kind of mortgage for everyone. Then we're going to talk about mortgages for home buyers who have low to moderate income, and also mortgages for first-time home buyers. I would like to tell you, first-time home buyers is obviously people buying a home for the first time in the US, but it can also include sometimes people who have not owned a home within the past 3 years in the US. So that's a strange way to say you're still a first-time home buyer, but that's what it means, is both those things: an actual first-time home buyer, or often someone who just hasn't owned a home here for 3 years. Then we'll talk about some specialized mortgages. Some of these mortgages do overlap. So it can be a mortgage for a first-time home buyer who is also a low-income home buyer. Okay, so they do overlap a little bit. And then finally, we're just going to close up with talking about some other kinds of financing help besides your main mortgage. All right, so that's quite a lot to take in. But again, you will have the PowerPoint sent to you. So, we're just going to highlight really some of the main things that you need to look at for each of these different kinds of mortgages. So we'll start first with the traditional conventional mortgage. This is pretty much available to anyone if you qualify, usually, as I said, from a bank or traditional mortgage company. It can have various options, including different options for your interest rate. Usually you will have to pay closing costs. There won't be any purchase restrictions. The main thing about a traditional mortgage is it may require a large down payment. So it can be as low as 3%, but it may be as high of a down payment as 25% of the purchase price. That's a big down payment, and it depends on how you qualify as a borrower. It usually requires a good, for you to be in a good position to be a borrower with that good credit score, good earnings history, and you don't owe very much else. Okay, so this is open to just about everybody, but it's not necessarily the best option for some first-time or low-income home buyers, because primarily of all the requirements, that it has, including the larger down payment. All right, back to Bob.
So we're going to start to talk about some of the mortgage programs that are designed for what are referred to as low to moderate income home buyers, as well as first-time buyers. And many of these programs that you see listed are addressing either the low to moderate income or first-time buyers, or both. So just real quickly to give you some idea, FHA, which is the Federal Housing Administration loans, that's a government agency. Maryland Mortgage Program, obviously, is a state-run program by the state of Maryland. NACA, the Neighborhood Assistance Corporation of America, is actually a nonprofit organization. So it approaches helping home buyers buy their homes a little bit differently. And Habitat for Humanity is the other nonprofit that is listed here. Again, a specialized program that we'll tell you a little bit about. And finally, Freddie Mac and Fannie Mae are two government-sponsored enterprises. They're linked to the federal government, and they assist in the home buying process as well. And we'll give you a feel for a couple of their programs. But the bottom line is all of these organizations have designed programs to help these low, moderate income and first-time buyers buy a home. That's what they're trying to do. So let's take a look at the FHA Standard Loan. And a lot of these programs have similar criteria, but then there's some little difference. So we're going to start with maybe the most generic of of these loans, the FHA Standard Loan. So this is for most home buyers, including the first-time home buyer. And what FHA and many of these other organizations does is it works with a set of lenders who then offer more favorable borrowing terms than you would find from, as Anne was talking about, what is called the traditional mortgage. And they're listed out there, for example, on the HUD website. Now, because they have low interest rates, this particular standard loan offers a low interest rate and a low down payment. It can be as little as 3.5% of the purchase of the house. So that's low, but not surprisingly, because of that, there's going to be the expectation that the home buyer have mortgage insurance. This is one of those that we've talked about, referred to in the past. And it's, again, protecting the lender because of the low down payment. In this case, the FHA Standard Loan, the borrower can have a low credit score. So this is trying to make home ownership available to those who don't have the best, haven't had a good record recently anyway, of good or strong money management. So if we go to the next slide, you can see a little bit of a difference. So this is still the FHA, but it's called the 203K loan. And so what's different? In this case, this is for the homeowner who is interested in purchasing an older or a damaged home. And because the home is possibly damaged or needs repair, the loan amount includes some kind of additional amount which is basically an estimate for the repairs that need to be done. And the loan can include up to the first 6 months of payments. If you can't stay in the house, can't live in the house because it is in need of so many repairs. Again, because it's FHA, you're going to be working with an approved lender. And again, it's a low down payment. In this case, because the house needs or the home needs repair, there's an expectation that a contractor, a professional repair person, if you will, does the work. Even if you think you are very good at fixing things, this program is not going to permit that. The house needs to be repaired in a professional way. There are going to be other fees, and perhaps not surprisingly, with this kind of a purchase, there's an expectation that the borrower has a reasonably good credit score. And this you will notice in a couple of other programs where the home needs additional work. There's an expectation that the borrower has a little bit more financial strength, which makes sense given the need for perhaps additional costs to support this particular purchase. And back to Anne.
All right, so another very important program for you to look at is the Maryland Mortgage Program. So this is actually a program available through the Maryland Department of Housing and Community Development. And much like the FHA loans that Bob just talked about, the loans are available through some approved lenders. So you'll go on the website listed at the bottom, and it will direct you to a list of approved lenders, and that's who you'll be working with. Again, this is for first-time home buyers, or, as we said before, you haven't owned a house for 3 years. But if you already you may also apply for this loan if you're not a first-time home buyer. If that's the case, though, then you will be restricted as to where you can buy that house, okay? So this offers better opportunities if you are a first-time home buyer, although people who are not a first-time home buyer, you can also use this loan, but there are restrictions, okay? It has a low interest rate. There is some down payment assistance available. And again, if you go on the website listed at the bottom here, you will see that, for example, there is an organization called Partner Match. This website will direct you to that. And that is another program that you can also use with the Maryland Mortgage Program, which does help you with down payment assistance. Okay, so it's like applying for two different programs if you do require some of that down payment assistance. There are income limits for the household. Very important with this program, you must not have a lot of cash on hand. So you must have less than 20% of the purchase price in what's called liquid assets, which really means cash. Okay, so this program is also for people who don't have a lot of cash available. In common with some other programs that we will be talking about, you must take an approved home buyer education program. These are mostly at the moment online. And again, the website will tell you where to go, but you must take this home buyer education program. Okay, which actually is great because it does really give you good information and will help you be a better and more informed borrower. Okay, and there is also some closing cost assistance available. Again, just look on the website for those details. So another very important program around in this area is called the NACA Program. And that stands for the Neighborhood Assistance Corporation of America. Now, this is available through HUD. I think we mentioned HUD formerly in connection with the FHA loans. HUD is actually the US Housing and Urban Development Organization. Okay, so this is going to be something that you'll see again also, and we do give you the website a little bit further on. So the NACA programs come through HUD. Okay, it offers certified pre-approved borrowing, and the way that you become certified and get pre-approved is that you have to sign up to attend a workshop, and again, this may be virtual at the moment. You have to work with a counselor, and you do have to put together things, you know, all the paperwork, which will include things like a budget. So if you remember, we did budget preparation some while back, but you are going to be, you know, getting that budget that you will be working with your counselor to put together, and you will be getting that budget approved. Okay, so there is some work to be done in this. This isn't just you go ahead and apply for it. You do have to go through these other steps. As might be expected, it is for low to moderate income households. You get a good interest rate. There is no down payment, which is, you know, for some people, that's really what's great about this program, no down payment. There are also no closing costs, although there are some fees, and mortgage insurance again is required. Also no credit score required. So this is, you know, quite a good program for you to look into if you feel like you are this kind of borrower. Definitely worth looking at. Okay, it's a very mainstream program. So also there is this Freddie Mac Home One program. Again, you know, you'll notice what is common here to some of these mortgages. It is for first-time home buyers. You again apply for this particular loan through a lender who offers it. I will say that this is not such a common program. There are only a handful of lenders that do offer this. But again, look at the website and you'll see which ones. It has a fixed interest rate. It has a low down payment, only 3%. So again, this is good because it is a low down payment. Again, you do have to take a home buyer education course. And for this one, it does require a good credit score. So you're looking at least 620, maybe as much as 680, but it does require that good credit score. Okay, so this is a less common loan, but still worth looking into. All right, back to Bob.
All right, so I'm going to talk about a couple of Fannie Mae programs now. Fannie Mae being another one of the government-sponsored programs like Freddie Mac. Now, the Freddie Mae Home Path program, what's different with this program is this is to enable Fannie Mae to sell what are called foreclosed homes. So you're limited in this case to those homes that Fannie Mae has listed that are foreclosed. Now, what does that mean? As you remember, when a borrower gets a loan with a lender, the borrower has to repay the loan. If the borrower doesn't, that lender can take the home. And in effect, the borrower does not own that home anymore. The lender does, the bank or the mortgage company owns the home. So there are organizations that end up, lenders that end up owning a fair number of homes, especially when the economy isn't doing well. And this is a way to enable people to buy those homes and enable those lenders to sell these homes. Normally, a foreclosed home is cheaper, and not surprisingly, sometimes it will need repair, because if you think about it, if a borrower can't afford to pay the principal and the interest on that home, is not keeping up with it, it's probable that that owner is not going to be able to pay for the repairs for that house. So that is one of the possible problems that will come with one of these foreclosed homes, even though the price is normally cheaper than what you would normally expect. Again, this is where the borrower would work with one of Fannie Mae's approved lenders and get pre-qualified, as they call it. The interest rate can be a little bit higher, but the down payment is still low. And one slight change is that while we had told you, I think 2 or 3 times, that many times especially the traditional loans want to see that historical, consistent earnings, very predictable. You can imagine if you were lending money, that's the kind of borrower that you would want to lend to, no surprises. Well, for these particular purchases, there's more flexibility in the kind of income that will qualify. It can be flexible in the sense that perhaps it's a little bit larger, 1 month lower the next, or perhaps the borrower is self-employed. And of course, when you're self-employed, sometimes income is less predictable as well. So there is that difference. Not required, but perhaps helpful, is the opportunity to attend a course. And this will offer the opportunity, if you will, to reduce some of the costs of the purchase price of this home. So something certainly to consider. And it does require a good credit score. This is a riskier purchase. And like that other one we were talking about, the credit score needs to be a little bit stronger to qualify for this program. If we move on to the next program we're going to talk about, Fannie Mae Homestyle Renovation Loan. Well, a renovation is significant repairs of a home. And So this is a program for purchasing a home that is in need of a lot of repairs. We're not talking about a few simple things that need to be fixed, but it's probably fairly substantial. And so the loan includes the purchase price plus an estimate of the costs of repair. And again, similar to some of these other programs, the loan amount can include the first 6 months of payments, again, if the home can't be occupied, can't be lived in. Similar to many, many of the other programs we've already talked about, there is a low down payment around 3%. And in this case, at least some doing it yourself, DIY stands for do it yourself. In other words, if you are pretty good at fixing things, at least in to some extent, you can be the person who's doing some of the repair work on this home. Not surprisingly, because of the risks in purchasing this type of a property, it's going to require a stronger credit score. But it can be an option for somebody who has the capability for doing repair work, and certainly has the financial strength and obviously the down payment is rather small, so that can make it a valuable idea for a purchaser. And finally, Habitat for Humanity, the other one of the nonprofits that we're telling you a little bit about. So Habitat for Humanity is helping lower income families who need better housing. The family needs to complete an application process and have a background check. And in addition, they need to commit to living in the home until the mortgage is paid. So this is a longer term commitment to the owning the home. The purchase price of the house or the home is below market cost, and there's a low down payment as well. But what Habitat for Humanity is, I'll say, famous for, is asking that the buyer, the borrower, do what's called sweat equity. Sweat equity means that individual helps in either the construction or other kinds of volunteer work for Habitat for Humanity. And there's the well-known story of Habitat for Humanity with its contractors, its builders, and its volunteers actually building a house, and the borrower, the homeowner, being part of that experience of building the house, everybody working together to create the new home for the family. And this does happen, but it's not always actually building a brand new home. It could be Habitat for Humanity has purchased a home and then is helping to finance it through using volunteers, including the borrower, to repair and get this home ready to be lived in. But this is one of the ways that Habitat for Humanity then is actually financing, if you will, the purchase of the house, is by using the volunteer work which also enables the purchase price to be below market cost. So that would be another option for lower income families who need much better housing choice. And with that, back to Anne.
Okay, so now we'll talk fairly quickly about some kind of specialized mortgages. So these are mortgages that are available for certain kinds of people. The first one is the VA Home Loan. I won't dwell on this too much. This is for members of the armed forces or veterans. It's a really strong possibility for you to look at if you are a member of the armed forces or a veteran, which simply means that you were previously a member of the armed forces. Okay, so they offer a very good program for those kinds of individuals. The next slide we have, this is called the USDA Home Loan. This stands for the United States Department of Agriculture. These are primarily loans for low-income families in rural areas. So if you're interested in living in a rural area, and I believe there are some in Maryland, you can apply through, again, an approved lender that you will find on the website down there for USDA. Okay, these are very favorable because the USDA is really trying to encourage people to buy homes in rural areas. There's no interest rate or very low interest rate, no down payment, and not much of a credit score requirement. So if you're interested in living in a rural area, definitely something to look into.
And Anne, why don't you just describe what a rural area would be?
Oh, yes. So a rural area is just really the countryside. So it certainly couldn't be a city. It can't even really be a town. It really means the kind of area where everybody lives, you know, in what's sort of obviously the countryside. So not urban areas, not even small towns, but very much the countryside. And again, look on their website, you know, and it will give you more details about that. So then we have what's called the HUD. Remember, we've mentioned that before, the HUD loans. So again, Department of Housing and Urban Development. This is a specialized mortgage for community workers through the Good Neighbor Next Door program. And community workers would be anything where somebody is working for the community as opposed to for a business. So for example, policemen, teachers, firefighters, that kind of person who has a job serving the community. Now for this, you would look on the HUD website listed below, and these homes are available usually in certain communities. So you may not have a choice of where you live. It may not be the area that you would really love to live in, but it could be, for instance, elsewhere in the state, like in Baltimore. But there are some homes, it seemed to me, available in pretty much every county in Maryland. Just there are less, you know, in some counties than in others. The homes are very much discounted. So the purchase price is often only about half of what the house is really worth. So, you know, again, if you're a community worker, it's well worth looking into this program. And there are some requirements. For example, the buyer must live in the home for at least 3 years. So, you know, again, if you're a community worker, this is well worth looking into because the homes are very much discounted, but you may not be able to live exactly where you would want to. So back to Bob.
Okay, are you wondering if there are any more possible options? And the answer is, of course there are. And so what we're going to do now is switch gears. These aren't big mortgage programs, but there are other opportunities to seek assistance on the financing side if you're thinking about buying a home. The first is rent-to-own properties, which some of you may have heard about. There's also the National Home Buyers Fund, which is actually a nonprofit that helps with certain funding of home ownership. The Fannie Mae Community Second Program. And there are a couple of other down payment assistance programs that we just want to share with you quickly. Rent-to-own properties. What this is a little bit what it sounds like. This would be for home buyers who don't have a good credit history, or maybe are in that category of having unpredictable source of income, are self-employed, and so they don't have the strongest credit history to begin with. And what the idea is to start by renting a home and then buy it at the end of a particular rental period. The rental period varies. It can be less than 2 years, maybe up to 6 years. And what is done is the rent includes an additional monthly amount, which is put toward the down payment on the purchase of the home that the individual is living in. Now, at the end of the rental, whatever that is, then the person who's doing the renting can either have an option, a choice about buying, or a requirement to buy. And this would be part of the original contract that the renter and the owner of the property would set up to begin with. In addition, there can be some upfront fees, and the purchase price of the property can be determined at the time when the home buyer is starting the rental, or maybe can be negotiated later. So there are a lot of different elements in this kind of a program that are variable. In other words, you can set them, but you might not know what they are. And one of the biggest drawbacks, if you will, is that these contracts can be rather complicated. So certainly, if you're thinking that this might be an interesting option, you would want to consult a lawyer to understand exactly what the contract is requiring you to do, and what the terms are when the contract ends, as far as what the price of the home would be, whether you have to buy, and so forth. So this is not a simple solution. It can be an option for those people who don't have a good history, credit history, variable income, and so forth. And I would suggest that you certainly do a fair amount of homework about understanding what these choices are, because it could be rather expensive too, because you are going to have to pay maintenance on the rental while you're renting it, which of course, if you were just renting without that option to buy, you wouldn't need to. And quite frankly, some people argue, well, why not put that down payment in your savings account? And when you want to buy the house, you will have it available for whatever house you want to buy. So this is obviously going to restrict you to the property that you're living in. So some interesting opportunity perhaps for certain people, but an awful lot of restrictions as well if you go through the detail. The National Home Buyers Fund is an opportunity for low to moderate income families to get assistance for paying the down payment and closing cost up to 5% of the purchase price of the home. Now, the good news about this is that frequently, most of the time, the borrower does not have to repay this assistance. The borrower does need to live in the home for 3 years. And the borrower does need to have a good credit score, can use these FHA and other loan programs that we've talked about. But getting back to the bottom line, this is an opportunity to just get, in effect, it ends up being a grant of 5% for those closing costs and assistance in down payment and so forth, those other costs that sometimes can be difficult to cover when you're buying a home. So definitely something to take a look at. And back to Anne. And home stretch.
there are there are a couple of other types of additional assistance. One is the Fannie Mae. I know we just talked about the Fannie Mae other programs, but there's a program called the Fannie Mae Community Second Program. And this offers some help with your down payment. Unlike what Bob just talked about, this is not a grant. This is an actual second mortgage. So you might end up with your main mortgage, and then if you don't have the money for a down payment or you don't have enough, you can take out this additional loan called a second mortgage, which sort of means you end up really with two mortgages. One is the main one, and then this is another piece. So the assistance is available, but just be careful, it does have to be paid back along with your main mortgage. And there is all sorts of other down payment assistance. If you go online and Google just down payment assistance, you're going to find all sorts of other programs. We didn't list all those because it would be way too confusing and way too much information. But, the one that Bob just mentioned is a good main one to look at. And, we threw in Fannie Mae as well, because that's another quite good option. But there's plenty more help online. Just look for it. So in summary, that was quite a lot today. And you will be able to look at the PowerPoint and, really do some research by yourselves. But if there's one thing that you would have learned this weekend, last week, I think it's that if you're considering buying a home, you must plan and then do some more planning. Okay, it's really important that you don't just rush into this, but that you plan. So you're going to have to make some decisions. Like, what do you want? Do I want to be a home buyer? If I do, what exactly am I looking for in that home? Talked a lot about that last week. What can I afford? That's really important. No point in looking at things that you can't afford. Are you really ready for home ownership? And again, go back to one of the earlier slides when you get the PowerPoint, and you'll see you have to get your finances in order before you start looking. And then what are my choices? I hope we've shown you today that you have multiple choices. It's all a question of doing some good research. You'll perhaps want to talk to a realtor, find out a realtor is a person, we discussed this last week. A realtor is a person who buys and sells homes. So they're sort of the agent or the in-between person who will show you what is for sale and will help you look at what is for sale. So you might need to consult with a realtor somewhere along this process, see what's available, talk to them about, loans that you're considering, and see just what you can buy, what is available at the price that you can afford with the loan that you think that you can manage. Okay, but plenty of choices. Be prepared to spend some serious time looking at all your choices. So finally, let's take a quick review of what we've done the past 2 weeks. In chapter 1 last week, we looked to see if we should even consider buying a home. Is it right for us? Benefits, disadvantages, costs, and how do I really start the whole process? And then today we talked in much more detail about financing that home loan or mortgage. And we gave you kind of an idea of what are the most common mortgages in this area, where you can find those mortgages and more details about them, the kinds of things in general that you should consider when you're looking at all these mortgage options, and really just, some little pointers about what to consider, what to avoid, how to get yourself prepared to be a good borrower. So I hope today was informative and interesting. We can certainly now take any questions or comments. I know it was a lot for you to consider, but now is the time to ask us if you have any particular questions or even any comments on what we showed you today. Was it helpful? Did you get extra information? Do you feel that you can cope better with the process?
I have a question. Thank you for your great teaching. I have a question. Is this programs dedicated or limited to the low houses, low prices houses, or not? It's not limited. It is not limited.
So generally, each program varies. So some of the programs will say they absolutely do say you cannot buy a house that costs more than this amount. But usually the amount will be what's called the median home price. So the websites that I looked at, the restriction on the cost of the house was very reasonable. You know, like one of the loan programs, for instance, I think depending on your household income, but you could buy a house that costs less than something like $465,000. So in general, the house price was not a problem. It's going to be more what you can afford. So they weren't saying, oh no, you can only buy these very cheap houses. They were saying, as long as you can afford it and you qualify, you can buy a very reasonably priced house. That wasn't really the big restriction in most of these loans. So obviously with foreclosures, that's different. But in most of the programs, that wasn't a big issue.
As you said, it is appropriate, or it is good for the people who has low income. Okay. And if sorry, I forgot. Sorry, I forgot the question. My question. Sorry, I forgot. I forgot the question.
That's okay. So many of these programs were good for low to moderate income people, and it's just a question of you know, like always try and go with a budget. Always try and have the paperwork with you when you're talking to a lender, so that they can see, and then they'll tell you, okay, with this kind of income, with this kind of savings, with this kind of credit score, you can afford sort of this much. Okay. Or even, sometimes I think a realtor can point you again in the direction of sort of how much you can afford. So, there are places where you can sort of figure out what you can afford. Usually the lender will not let you borrow more than they think that you can reasonably pay back. So that's the big thing. It's not so much the cost of the house, it's what the lender thinks you can afford. Okay. Does that answer your question?
I have another question. For first home buyers, the benefit, like the government gave us benefit, is like the rate is fixed or not fixed? I don't understand with that.
So it depends on the lender. So sometimes, I think we indicated on the slides where the rate was fixed. More often than not, it is fixed. If it's just a heads up to you to be careful if they say it's variable, because that means it can change. So if your loan is for 30 years, if the interest rate is, say, 5% today, in 5 years' time, it could be 8%. So that's where a variable loan is not as good, because you don't know what's coming, from year to year. So the fixed one is always good, because then then it's predictable. You do have other choices along the way with a variable interest loan. That's not to say it's bad. It's just to say that it's less predictable. And it really depends on the lender. So on the slides, we told you where it was definitely fixed. If we didn't say anything, then it meant that it could be either one. You just have to ask. Okay? Does that answer? Yeah.
And obviously, whether you have a fixed or a variable rate loan, it's important to know what interest rates are at the moment. When interest rates are quite high, then you might not want a fixed rate loan because you're hoping that interest rates are going to go down. And that is what has happened with some of the people who bought homes several years ago at a fixed rate and have now refinanced because they wanted to take advantage of a fixed rate at a much lower level now. So some of it has to do with knowing what interest rates are right now and what is best for your planning purposes. But right now, a fixed rate loan is a very good choice because interest rates are extremely low. So yeah. The idea is you lock in now to a very low rate. It's highly unlikely that it can get much lower than what it is now. Who knows? We don't know, but they're unusually low right now.
Thank you.
Mm-hmm.
I'm sorry. I want to know more specifically about the rent-to-own properties. You say you can live for 2 or 6 years before to buy the house?
So the lender will tell you. So some of these houses are owned by private people, a private landlord. Some of these houses are owned by corporations or businesses. It varies considerably. From what I read, it seems like 2 or 3 years is more normal than 6 years, but it depends upon the lender. It can vary. There's no way of telling. You just have to ask each lender. There is actually a website called Rent to Own. So it's just like it looks, the title, Rent to Own. That website gives you more information about these properties, and it has a lot of properties listed there. If you just Google Rent to Own, then private landlords will come up and you can see some different options there too. But this kind of thing seemed to be very variable depending upon the individual lender. Okay, so but I will say that 6 years renting was a bit less usual than 2 or 3 years. Okay.
Okay, thank you.
The other thing to keep in mind with the rent-to-own programs is there's very little regulation, very little structure.
You finished the homework? All homework?
You need to be careful because banks have lots of rules. Government has lots of rules and regulations. So that's why you would need a lawyer to help you if you want to think about a program like that, because you want to make sure you know what the deal is before you sign paperwork.
Okay. For this, you need to the lawyer, right?
Yes, you should get a lawyer. You're going to even think about this and don't sign any papers.
Yeah. Okay.
So you know what all of that says about what you're getting into.
Okay.
You gave it to us great information. I'm so happy for you. Really, really.
Good.
Thank you very much.
So any more questions while we're here?
Just one quick question. So ideally, what % of your monthly salary you should commit for your mortgage payment? In other words, let's say your monthly salary is $1,000 as an example. How much you should budget for your mortgage payment?
So we mentioned last week it was about 1/3, wasn't it, Bob? For total. So that's for total debt. So you have to factor in about a third of your income should go to, it has to include all loans and all debts. So like it can be a third just for your mortgage, but if you have other loans like a student loan or a car loan or credit card debt, you have to add all those things together, and all together that should make about a third of your income. That's just a